I'm Charlotte McLeod with investingnews.com, and here today with me is Adrian Day, president of Adrian Day Asset Management. Thank you so much for being here.
Well, thank you. Thank you for asking me, Charlotte.
Oh, of course. Always great to be checking in with you. And of course, we will start with gold as we usually do. So we're checking in after a few months. We talked last at PDAC in March, and a lot has happened. We've seen gold go up to that $3,500 level. I know we've pulled back right now. And we've spoken a lot in the past about what's driving the price, and the central banks seem to be at the top of the list. So I wanted to start by checking in with you on that, if the central banks are still kind of the top driver you're looking at, and maybe what comes next after that.
Right, no, good question. We did have, a few months ago, we did have a bit of a pause from several, or slowdown in the buying from several of the central banks. But central banks are still far and away the largest driver. But of course, it's all what happens at the margin. You know, if they used to buy X and now they buy X minus 10, that matters. But the central banks are still buying. China, as you know, in the latest numbers that came out yesterday, China's still buying. That's the 8th month in a row that they've been buying, because they paused last fall. So they're still the main buyer. Where we've seen a bit of a change recently, or the biggest change recently, is with the non-official Chinese sector. That buying, which shot up in the spring, has subsided. Early spring has subsided. I don't know that that's permanent. It's probably coming back. But the next move, it seems to me, is with North American investors, not the Ray Dalios and Bill Druckenmullers and so on, but ordinary, not just retail investors, but investors, family offices, small institutions, investment advisors telling their clients, money managers, etc., all of that. So I think the next leg is going to be the North American investors, who've really been out of this market, as you know.
So they are waking up, and maybe we can talk a little bit more about what is causing them to become interested now, and what will put them further into the market.
No, that's an excellent question. I think the first thing that's causing people to look is simply the fact that gold has moved up so much for so long. And so, you know, when it started to move up, people didn't really notice. And then you sort of notice, but say, oh, it's only temporary. But I think now it's clearly a thing that you have to look at. So that's obviously the one thing. The miners are obviously doing incredibly well for investors, for serious investors. The miners are doing well, and they can see the growth in the cash flow, growth in the margin, that is leading to growth in the cash flow. And it's, for a lot of companies, there's free cash flow, which is, you know, an unusual thing for gold mining companies. So people are beginning to see that. And again, that was not just 1 quarter or 2 quarters. That's now been 6 quarters of increasing cash flow on very, very strong margins. So that's getting attention. But I think what's going to drive it looking forward, okay, step back. Remember, a typical North American investor buys gold, and by gold I'm now talking about gold assets generally, when the economic environment is right, when the economy's slowing, because you think that means the Fed will start cutting rates, when inflation is high and increasing, when rates are low and being cut, and when the dollar's falling. So that's the perfect economic environment to be looking at gold. And that's the precise opposite of what we've had for the past several years. So it's no surprise to me, it's not illogical, let's say, it's not illogical that most North American investors have not been looking at gold, because the economic environment has just not been conducive to it. But as I see it, all that's beginning to change. The dollar's obviously down a lot this year. It's oversold, it's significantly oversold on the short term, in my view, but that's a different subject. But the point is, the dollar's been falling after being consistently strong. Inflation is sort of, well, it's not under control, and Jerome Powell, the Fed chairman himself, is concerned. So if he's concerned, shouldn't we be concerned? There's indications that there's more indications that the economy is slowing, both the consumer spending. If you look at the patterns of consumer spending, Are they spending on necessities, or is there a lot of consumer discretionary spending? There's no consumer discretionary spending, and so that's a bad sign. And of course, the jobs market is nowhere near as strong. If you look under the hood, under the bonnet, is nowhere near as strong as the headlines would suggest. And we can. You only have to look at the revisions to see that that's true. So clearly the economy is slowing, and so all of the economic factors are now beginning to move in various degrees in gold's favor. And the only thing holding up at the moment, of course, is the S&P in the stock market. And but you're seeing the Magnificent Seven are all starting to roll over, or most of them are. And so that's making people look for other places to put their money.
Right. And it is the Magnificent Seven who are mainly providing that support, right, for the S&P. So if they start to be turning down, then the whole thing would follow.
No, well, yeah, I'm not looking for a market crash anytime soon. One never knows, but that's not my base case. We're already seeing the market breadth is bad, but it's not as bad as it was at the end of the year. So we're already seeing that there is some dispersion, and there are some stocks doing well in the S&P, other than the Magnificent Seven. It's not as bad as it was. We're already seeing some money flowing into European stock markets. Europe, of course, not of course, but the European markets have outperformed the US this year. That's the first time in many, many, many years. So and that's because of the flows. We're seeing flows from US into Europe, but we're also seeing a lot of the steady flows from Europe into the US market are slowing. And I think that's a major theme, frankly, going forward, that a lot of the money from abroad that would typically just flow regularly into the US stock market, I think we're going to see that slow dramatically and even reverse in the face of a lower dollar, in the face of tariffs, in the face of just the general, I don't want to say hostility, but the general government attitude towards foreign investment. So I think we're going to see that reverse.
And going back to the U.S. economic outlook, so you've outlined cracks that are appearing there, and we've talked before about the possibility of stagflation. Is that still how you're feeling? I've been reading about how Jerome Powell and the Fed are hinting that that's what they're not saying it, but they are hinting. So how are you feeling?
No, absolutely. Because 6 months ago, of course, Jerome Powell said, I don't see any stagflation. I don't see the stag, and I don't see the flation. And he's not talking that way anymore. That's still my base case, but I think we're going to see a slowing economy, and we already are seeing a slowing economy. So I think the economy is going to slow before inflation. I'm not expecting inflation to move up dramatically anytime soon. You know, when the Fed cuts rates, if the Fed cuts rates later this year, and the dot plot suggests that they will. Jerome Powell didn't seem as though he endorsed what his other members' expectations were, but nonetheless, if the dot plot, they're looking for 2.5 rate cuts this year, so that means they're going to have to start by September. Well, they don't have to, but they would. You know, if they cut rates, I think we're going to start seeing the inflation numbers move up a little bit. But I would term the inflation at the moment as more stubborn than that it's just going to run away on the upside. I don't see that. But you know, you look ahead next year, and most importantly, if the Fed switches to QE. Which we can talk about if you want, then we're going to start to see inflation move up. But always with a lag. These things always happen with a lag. You know, and the lag from cutting rates can be 9-12 months. So we're looking at the end of next year, in my view, before inflation numbers really start to pick up.
Okay, I will come back to QE, but before we go there, I wanted to ask you what you make of Powell's comments saying the Fed would have cut rates if it wasn't for the whole tariff situation, which of course is escalating at this time.
Yeah, I think that's nonsense, frankly. Powell is very reluctant to cut rates because he knows that inflation is not under control. And he's right in that. I respect the fact that he's holding. I don't often respect anything the Fed does, but so he's reluctant to cut rates because he knows inflation isn't under control. He also doesn't like his boss or the big man in the White House keep calling him a moron and telling him he needs to cut rates. I mean, what would you do if someone kept saying that? You'd dig your heels in, right? Sorry, what was the question?
The comments about we would have cut.
Yeah. Oh, tariffs. Yeah. No, I think that's just absolute nonsense. I think that's partly an excuse. He's absolutely correct when he keeps emphasizing the uncertainty. No question about that. There's an awful lot of uncertainty around. The policies keep changing from day to day, from hour to hour. A lot of uncertainty, and that means that the outlook is an uncertainty. That's a reasonable, in my view, sorry, I'm sounding a bit arrogant here telling the Fed, but that's a reasonable justification for just holding policy where it is for a moment in time. But tariffs themselves, look, tariffs are not inflation. I mean, and Powell should know that, and economists should know that. Theoretically and empirically, tariffs do not cause inflation. On the contrary, they tend to lead economies to slow and move into recession. We don't have to go back to the 1930s to see that tariffs are not good for the economy and do not cause inflation. And so, no, that's just nonsense in my mind.
Okay, good to go over that. And we'll go back to the Fed and QE, which you're mentioning before. How do you see that potentially playing out?
Yeah, well, it all comes back to the funding of the deficit. You know, as we've talked before, I'm sure, when the Trump administration came in, the cupboard was bare. Basically, the whole year's appropriation, the whole fiscal year's appropriation, had already been spent by the Biden administration, and Janet Yellen herself said that on the Tuesday after Trump was sworn in on the Monday, the Treasury will hit the debt ceiling. So they were at the debt ceiling. The Treasury general account had been completely run down by Yellen, and so when Trump and Bessent, the Treasury Secretary, came in, they really had very, very little room for maneuverability. So where we are now is the debt ceiling's been increased, but it's been increased at the beginning of July. So we've got July, August, September. That's the end of a fiscal year. That's the end of a fiscal year. So they've got, what did I say? That's 3 months. They've got 3 months to sell an entire year's worth of treasuries. So all they've been selling this year to date, most people don't seem to realize this, all they've been selling this year to date are treasuries that mature. 100 million matures, they sell 100 million. But they haven't been able to increase that at all because of a debt ceiling. Now we've got an extra $1.6 trillion that they have to sell in 3 months instead of over 12 months. So it's a huge amount of supply, a huge amount of additional supply. That's regardless of the debt going up anyway. A huge amount of extra supply in a very short period of time. And that comes at a time when some of the biggest buyers of treasuries are no longer there. China, Japan are no longer there. Japan is now a seller, not because they're hostile, but just for economic reasons. The Social Security Administration, which is one of the largest holders of treasuries, they are not buying at the moment because they have no money to buy. And we could go through all of the different buyers. And so what Bessent, the Treasury Secretary, is trying to do, they're trying to sort of cobble together different sources of buying to sop up all of this extra supply, and that's why they're talking about the banks, the big money center banks, not having to have so much money on reserves, and then Senator Cruz in Congress has said that he's introducing a measure to do away with paying interest on the reserves. I'll say everybody criticizes him for that, but that was the case pre-2008. That the banks were not paid on reserves. They had to put a certain amount of money in reserves, which is not a bad idea for a bank to have reserves, and they didn't get interest on it. But so it's a carrot and stick. You don't have to put the money on reserves, and by the way, we're not going to pay you any interest on the reserves. Oh, and by the way, some of that money really ought to go towards buying treasuries if we're going to go through with this. So that's maybe $250 billion. I don't know how much. Jamie Dimon, the CEO of Chase, has said we're not interested in buying more bonds. So I don't know how that's going to go. Is there going to be some arm twisting? If we do this for you, then you have to do that. And there's a few different things like that they're doing. But I think ultimately my sense is that if they can't sell all of those treasuries at reasonable rates without rates moving up dramatically, then the Fed is going to come in and start QE again. As you know, the Fed's had QT for the last, 2 years now, I guess. And but this year, they're already winding that down. They've gone from $35 billion a month of runoff to $25 billion to $5 billion. And in the last 3 weeks, they haven't sold not a single bill or a treasury or mortgage-backed security. Not a single one has been sold. So $5 billion a month on a $7 trillion balance sheet is sort of a rounding error. It's meaningless. So in my view, I would say the QT is effectively dead. And the next step would be if they can't sell the bonds at a reasonable rate of interest, then the Fed is going to start buying again. Now, if the Fed starts buying again, they probably won't call it QE. Remember, they tried to avoid QE2 and QE3. They tried to come up with different names for them, remember? Operation Twist and all that kind of stuff. But I don't think they can get away with that this time. And if they start QE again, even on a relatively small scale, that is very, very bullish for gold. Very bullish for gold. And it will be, I was going to say bullish for inflation. I don't know if that's the right phrase, but it'll mean inflation will go up, but it will go up a year or 16 months from now.
That is quite a situation that is setting up there. That'll be interesting to follow. And so you're saying at the beginning, this is a perfect environment for gold that is setting up. This is part of it.
Yeah.
And we have had the price pull back from that 3,500 level. But you've told us in the past, that would be okay if we take a bit of a breather at a lower level. So
yeah, it's really, obviously with any market at any given time, there's lots of factors, right? Some bullish, some bearish. And it's a matter of trying to weigh those different factors. Where we are right now, first of all, July and August have, for the last several years, for the last 15 years, they have been seasonally strong months for gold. So that would sort of maybe weigh against it. We've already had a pullback from 3,500 to 33. Okay, that would weigh against a further correction. But on the other hand, you could see a confluence of factors that are not completely out of a realm of possibility. I'm not talking about a balanced budget, but a confluence of factors in the near term that could cause gold to correct a little bit more. We really haven't had a proper correction in gold. The 3,500 was a bit of a spike. I know it did get there, it's real, but we really haven't had a proper pullback in gold for the last 3 years. If you get, what are they talking about? Is it 8 or is it 10 trade deals going to be announced very, very soon? Or was it 7 or was it 11 or was that yesterday or was that this morning? But anyway, they're talking about if you get a bunch of trade deals announced with important partners, like Japan and Korea, and the EU has said now that we're close to a deal. So if you get trade deals announced, if you get some more reasonably positive news on the economy, so that interest rates are not going to be cut again. If you get some more Arab countries particularly say Saudi Arabia, decide to join the Abraham Accords. They've been there's a lot of talk about that right now. I think that's a confluence of factors that could see a little bit of a steam taken out of demand for gold and cause a bit of a pullback. If we see that over the next, say, 6 weeks, month or 6 weeks, I would see that as an incredible buying opportunity. And it may not even happen, but if you look out 6 months, a year, it's difficult for me to be more bullish than I am, and that itself is a dangerous thing, I realize. But all of the factors that people have been buying gold, the central banks buying gold to diversify out of the dollar in the face of dollar weaponization, I think at the minimum we can say that hasn't gone away under the current administration. They didn't start it, of course, but when you're threatening tariffs on the BRIC countries because, if you go against us, we're going to tariff you, that's all wildly bullish for gold. Is Brazil going to say, oh, we're so sorry, Mr. President, let's go buy some of your treasuries? No, they're going to say, let's dump your treasuries and buy as much gold as we can. So all of these factors, and then on top of that, you've got the changing economic thing that we talked about, which is going to get more people interested in gold. So any pullback would be a buying opportunity in my mind.
For gold and the gold stocks, I imagine.
Gold stocks as well, yeah. The gold stocks will really take off. We're already beginning to see it. The gold stocks have done well. And it's incredible, but when you see the XAU or the GDX up, 55% or whatever in the last year, and that's in the face of outflows from the GDX, from the GDXJ, that's pretty astonishing. So can you imagine what's going to happen when ordinary investors, and by ordinary, I don't mean just small investors, I mean ordinary investors, that's including money managers, registered investment advisors, and so on, start to buy gold? And we're just beginning to see that. The fact that silver's outperformed gold this year, the fact that the GDXJ has outperformed the GDX, even though the GDX J isn't really juniors, but nonetheless, the somewhat smaller stocks are outperforming the bigger stocks. These are all signs of interest from ordinary, what I'll call ordinary investors, from retail investors.
Makes a lot of sense. So good to go into the gold stock opportunity as well. And on that note, I know that you're a big fan of the royalty companies. Yeah. And I wanted to ask about a little bit of some timely news, because we had a deal earlier this week, I believe, the one with Royal Gold, Sandstorm Gold, Horizon Copper. Any thoughts on that? Do you like to see consolidation in the space?
Well, we definitely need consolidation, among the smaller ones. There's too many, and Sandstorm of course, will be in the mid-tier of that, but there's definitely too many of the smaller ones in my mind, because when you're a small company, it means your cost of capital is much higher. And when you're buying royalties, you need access to capital. So it's not like so it's a critical thing. It's not just, I've never been a person that says big is better, but in the royalty space, bigger, not, is really better, because your cost of capital, which is how you build a business, is better. And you compete for deals. So definitely we need it there. There's always the problem with consolidation. So you can have two smaller ones merge. But the problem with the kind of Royal Gold Sandstorm deal, the problem with more of those, someone buying a Cisco, someone buying Triple Flag, I'm just making these up, someone buying Metalla. The problem is that if you've got a company, and Metalla is trading at a discount to NAV, so I recognize that. But if you've got a royalty company that is trading at 1.5 times NAV, and someone's going to buy them, they'd have to pay a premium. So let's say they pay a 30% premium, which now means they're paying 2 times NAV. Let's just say, just to put some names on it, this is purely hypothetical, just as an example. Let's say Franco says, you know what, we'd really like to buy Melodic. That's an incredible royalty, right? That really is a world-class royalty. We want that. We'd definitely be prepared to pay 2 times NAV to buy Melodic. but they'd have to pay 2 times NAV for the whole company. And there's a lot of stuff they don't want to pay 2 times NAV for. And that's the problem with a bigger company buying a smaller company. You're just buying a lot of stuff. You're having to pay a premium, and you're having to pay a premium for things you don't want. So I'm not sure we're going to see an awful lot of those deals, but I do think we'll see more of the smaller companies merge. And by smaller, I'm talking the mid-tiers like Metalla and EMX. And I'm not saying any of those is going to merge soon, but that kind of, 300, 400 million market cap company.
Right. That gives a good idea, I think, of what could be happening. So
Yeah.
thank you for going into that. I know we usually focus heavily on gold, but I thought it's a good time to mention silver to you as well, because we have the price on the move and investors, I think, looking at it, maybe feeling cautiously optimistic, but not sure, because silver, of course, is a volatile metal. So your thoughts on silver and what we will see as this move sustainable?
Yeah. Well, my sense is that we found a new floor, and the new floor is definitely, well, I say definitely, but the new floors are 30 and, perhaps even a 33. So, we've broken out, and I think we've got a new floor at a meaningfully higher number than we were before, perhaps even 33. But I'm not sure we're going to see silver shoot to $50 or $100, anytime soon on this move. I've had people ask me on silver, is this it? I'm not sure what it is, but no, I don't think this is it. The thing about silver, you've got, obviously we know this, you've got the industrial demand, and then on the supply side, you've got the fact that you've got two things that are grossly different or vastly different from gold. First of all, you've got most silver supply is byproduct, so about 75% of silver supply is byproduct, and it's byproduct not of gold, but it's byproduct of zinc and lead. And so I've said this before, the lead miner in Bolivia does not build a new lead mine with 10% silver byproduct just because the price of silver went up, right? And so silver supply does not respond well to changes in the price of silver, which is one of the reasons that the silver price is so volatile. That works on the downside as well as the upside. You don't close your zinc mine because the price of silver went down. The second major difference is there are no stockpiles of silver, no meaningful stockpiles of silver. And so if you get a big run suddenly, there's no big supply to suddenly come on and take that away. And that's another reason why silver moves can be so dramatic. So the setup for silver is certainly very, very good. But in order to get that move, you really need to start getting retail investors come in droves, because when they come in buying silver in droves, and you get inflows into the SIL and so on, the PHYS, spot physical silver, when you start to get inflows into those ETFs and people buying silver coins at the coin dealer, there's nothing to stop it at that point, until it just gets crazy and people who bought at 40 decide to sell at 60 or whatever. And we're not there yet. And there are not indications, talking to my friends in the coin dealing business, looking at the flows into the ETFs, there are not indications. There's a shift, but there's not a flood of money pouring in. As you said, people are cautiously optimistic. And so for these reasons, I don't think this is it, whatever it is. But I do think we've got a new floor, and so at some point we'll see those kind of flows come in, and then silver will move dramatically.
I think that's a very reasonable take on silver. And yes, I would also like to know what people are meaning when they ask if it's it. We'll find out when it's here, I guess. So one more question for you. I know we've got to get you back out into the show here, but this is another one related to timing. So silver, maybe not quite the time for silver to do its move. I'm curious about copper. So we've talked about copper in the past, and it's more of a long-term story, but we've had this interesting news this week about I think there's still potential at this point, 50% tariffs from Trump. And I'm wondering, has that moved the copper story forward at all? Is it too soon to tell?
That's a really good question, yeah, because the reason I'm interested in copper and the fundamental driver of copper is the fact that the demand is growing for many reasons, but the supply there's real constraints on increase in that supply. And with copper, because the lead times are so long, you have very, very good visibility, 5, 7, and even 10 years ahead of what the potential demand could be. And there's just going to be a shortage. Now, when we talk about a shortage in commodities, of course, other than a short period of time, there's never really a shortage but when we say there's a shortage, we mean the price will go up. And that's the real demand for me. These tariffs are so difficult to read.
Yeah.
Because again, I don't want to I don't make investment decisions based on, what the latest tariff thing is, because it may or may not. We don't know how it's going to play out, frankly, and it may even change tomorrow. It does suggest maybe if you're interested in copper, it suggests maybe you look more at U.S. copper. So that will be Freeport as a producer, which of course has mines around the globe, but they have a lot of copper domestically, or might be, on the development side, looking at Ivanhoe Electric, for example, which is in Arizona. So just focusing more on U.S. projects, that would make sense. But I hate to give that such a waffly answer, but I sound like Jerome Powell now. When there's so much uncertainty, but copper's one of those things that makes me think, because the copper price, until this week, the copper price hasn't really moved up dramatically in the face of all of the analysts sort of more or less agreeing on what's going to happen 5 and 7 years out. And it reminds me very much of that hackneyed phrase of Hemingway, how do you go bankrupt? Slowly at first and then suddenly. And we're in the slowly phase, which is the phase we should be accumulating copper, tariffs or no tariffs.
I think that's a fair answer given all the uncertainty. So that's everything from me. I will let you go unless you had any final thoughts to leave people with.
Yeah, the only final thought I would have is when I mentioned that there's a confluence of factors that are all reasonable factors, but could come together and cause gold to drop. I would just say, or to correct, I would not make that my dominant theme. My dominant theme should be 6 months, 12 months, and 18 months from now. And if you look at the gold stocks, don't focus on the fact that they've already gone up 55% in the last year. Focus on the fact that the valuation metrics have increased so much. When the gold price goes up, the NAV goes up. So now the price to NAV for the big companies is lower today than it was 2 years ago. And when the margins expand the way they've been expanding, the cash flow goes up. So the price to cash flow valuation metric is lower today than it was 2 years ago. And so the valuations of these companies today, despite the 55% increase in the stock price, are lower today than they were a year ago. That's the thing to focus on. So you can still buy really good quality companies at very low, sometimes lowest decile, sometimes lowest quartile, but well below average valuation metrics. That's the thing to focus on.
Okay, all right. Well, keep our eyes on that. And thank you so much for coming on today to go over what's happening in gold, silver, a little bit of copper.
Well, thank you so much, Charlotte, for having me. Thank you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Adrian Day.